This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 102. ECB fiddles whilst Rome burns.
Welcome to the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie, and today there's trouble brewing in Italy. There's a massive flight from Italian government bonds as the country is set to head back for another emergency election. So is this the Maastricht Treaty finally getting its comeuppance? That's what we ask today on the Debunking Economics Podcast with Professor Steve Keen. Well, as we are recording this, Italy is in meltdown. People can't get rid of their Italian government bonds fast enough, which means they've seen the price drop, and of course that pushes up the yield. Normally the yield on government bonds moves at best a few basis points in a day, maybe 7 or 8 hour push. But in one day, Italian 2-year government bond yields rose 190 basis points. Why? Well, because it looks like the Populist League and five-star parties can't form the government they wanted to form. The president has vetoed their choice of prime minister and finance minister, but he's put a classic monetarist into the role. The parties are threatening to impeach the president, and it looks like they're going to be going to the polls as soon as July, with the populist parties gaining more support in the opinion polls. So, Steve, I know you're going to say I told you so I'm going to let you do that. But also, tell us why this is happening.
Okay. Well, actually, I said them first when I wrote the first edition of Debunking Economics, and I described the Maastricht Treaty. That was back in 2000, 2001, so it's just after the Euro began. And I described the Maastricht Treaty as a collective suicide note by the countries of Europe. And I can't say I was the first person to make a criticism like that, because two diametrically opposed economists made much the same argument. My favourite is Wynne Godley, who was the father of the whole modern post-Keynesian approach to economic modelling called stock flow consistent modelling. And writing back in 1992, literally as they were trying the ink on the Maastricht Treaty, he wrote a wonderful paper which is still available. You can get it from the London Review of Books. It's called Maastricht and All That. And at the end of it, he says that if you give up the opportunity to devalue a currency, which is what you do by forming a currency union like the euro, and you don't have a nation-state level treasury, like a European level treasury, enabling taxes and spending to balance out what happens with flows of goods and services and money and ordinary transactions, then there is nothing. And you also enforce the austerity rules of the euro, which won't let a country spend more than 3% of GDP is in excess of government spending over taxation revenue, so there is nothing to stop a region suffering the process of terminal decline, leading in the end to immigration. Immigration is the only alternative to poverty or starvation.
Which is what we've been seeing in Greece, of course. We've been seeing massive emigration from Greece, and yet no one seems to talk about it too much.
That's right. I mean, they're ignoring the fact that the only way to survive what the European Union is doing to the deficit, internal deficit, trade deficit countries within Europe, is people are leaving. It's depopulation. It's not just in the actual existing EU. I was in Croatia about a year ago, and I was driven from Zagreb down to Pula by the people who invited me to speak there. And we were going through village after village, and they were saying these villages are empty now. And I said, what's going on? So the activity has collapsed, and people have just emigrated. They left the country. So the whole impact of trying to impose what the European Union believed was sound finance is the depopulation of large parts of Europe.
So, and it is the problem being a half pregnant cow with the euro, isn't it? I mean, we haven't gone all the way of the United States, where it really is a United States, and you have a central bank and a government working hand in hand to try and deal with the tools they have available. Here you've got a whole load of disparate governments with only limited access to those tools and a central bank, which possibly, dare I say, it might be a little bit German and France focused.
That's the trouble. I mean, because the whole focus of you've got to look at the history of Germany, and of course, whenever anybody talks about what I see as genuinely sound finance, you get what about the Weimar Republic line? Well, that scarred Germany's collective memory so heavily that they are terrified about inflation and do anything to try to prevent it. And part of it was the idea that government should basically live within their means, that whole idea which you'll find in England as well, of course. And that meant they were trying to restrict government spending. Now, what they did with it was restrict the creation of money by governments and leaving it only to the private sector. So it was a recipe for a private debt bubble which burst when the global financial crisis came down in Italy, in Spain, and virtually everywhere else, where private money creation made up for the absence of government money creation. And it's been a catastrophe.
So, if Italy wasn't part of Europe now, what would they be doing if they saw that the economy just wasn't growing, wasn't keeping up, that there was rising unemployment, people weren't buying stuff? What would be the reaction of the Italian government? How would they get out of this mess if they weren't bound to the euro?
Well, they'd simply have an increase in government spending because of an increase in the level of unemployment. They'd have a decrease in taxation because of fallen profits. They'd have to issue more bonds to finance that, which the Central Bank of Italy would then they'd be sold to the financial sector in Italy, and then if the central bank bought those bonds off the financial sector in open market operations, that would create additional money. The normal story ends up being that just by the whole process of open market operations in America, for example, for the last 120 years, on average, the government deficit's been 2.4% of GDP, and it would just create the additional money which would circulate in the economy. And so this, in fact, there is no downturn, there is no crisis that preceded this. The crisis is preceded by is caused by the monetary system itself this time round. But yeah, it'd just be a normal, operation. What Keynes used to call the automatic stabilizers would be kicking in, and we wouldn't be talking about Italy.
Yeah. Put simply, if private spending is down, you increase public spending, and then when things kick in, you can start to turn it back a little bit. You can't. You can't turn both down at the same time.
Yeah, and that's unfortunately what the Maastricht Treaty actually requires the countries to do. When the private sector turns down, then the government deficit rises, and the Maastricht Treaty requires you to cut the government deficit, which means private spending has fallen, and the Maastricht Treaty forces you to reduce government spending as well, and the economy declines. And this is the fallacy of so-called sound finance.
So Italy can issue bonds. Well, they do issue bonds, so they do issue their own debt. But the ECB has to. Well, if they issue debt, it gets bought. It either gets bought by private investors or it gets bought by the European Central Bank. Now, the European Central Bank is not going to buy bonds if they see too much of it being issued and it's not meeting their stipulations. And I guess that's part of the problem, isn't it? It's sort of stopping them from issuing those bonds now.
Yeah, I mean, because at the moment the only thing that the ECB is only required to buy government bonds if the conditions of the Maastricht Treaty are met.
Yeah.
And those conditions include private government debt being less than 60% of GDP, and the deficit being in a particular year being less than 3% of GDP. Now, what's happened with the crisis is that Italy's, after the financial crisis hit, that deficit's been as high as 15% of GDP, and that's simply because tax revenues plunge during a downturn and government spending rises. So the ECB was under no obligation to buy more than 3% of GDP worth when they were issuing 15% of GDP worth. And that's why you had these astronomical valuations not valuations, but the astronomical interest rates on the bonds. And that Draghi came in and said he'll do whatever it takes, which means he would actually go beyond the legal mandate he has and buy whatever's necessary to reduce the bond prices. That's what stopped the crisis last time round. So the only way the crisis was prevented back when it hit in, I think 2012 or thereabouts, was Draghi saying, I'm not going to abide by those rules. Now, nobody said, oh, you naughty Draghi, we've got to go and take you and cane you. So when it suits the European authorities to try to hang on to the euro, they will break the rules of the euro. And in fact, they broke the rules of the euro in the very first place by allowing Italy in, because unlike Greece, which had a lot of help, I think it was Goldman Sachs, to hide the amount of debt that it had, everybody knew that I think Italy's level of government debt when the crisis began was about 110% of GDP. So even though the rule said you must be below 60% and must have a 3% ceiling, right from the outset, Italy didn't meet those rules, and nothing was done between 2000 and 2007. So it just shows that the whole thing is more of a political system than an economic one,
yeah.
driven by the so-called political imperative to unite Europe to stop wars occurring, but I think it's uniting Europe and causing wars, ultimately.
So when you have just that, when you have politics driving the finance markets, I mean, it tends to have a sort of like quite a big reaction, which is what we've seen this week. And then things moderate, and sort of like, we had that, as I say, one day in which bond yields increased 190 basis points, which I think is the most that's happened in 25 years. But then the next day, the price of 2-year bonds or notes picks up again. There's always bargain hunters. The Italian debt office is selling off another 6 billion euros of 5 and 10-year bonds. People are buying them, presumably, otherwise they wouldn't be issuing them. So they can't be that concerned. I mean, is it one of these things that, is perhaps a storm in a teacup? It looks bad, but then it's sort of the markets somehow moderate it and they muddle through somehow? Or is this the start of something big?
I think it's the start of something big, but let's actually just clarify that thing about the increase in the rates. I'm looking at the Bloomberg yield on 2-year debt in Italy right now, and the yield, the level that it rose from, if we go back to May, the level of yield on 2-year debt, I'm not sure whether this is nominal or real. I think it's actually nominal. I've been sent it by a friend from a Bloomberg terminal. The level in May was minus 0.2%. Okay, so the market, the price of the bonds were selling above face value, meaning that the yield nominally was negative. Now then, it hit zero in by the looks of it late May, mid-May, and then after this crisis has risen to 2%. But 2% in historical terms is a very, very low rate of interest. In fact, 2%. This is actually the nominal yield, so it's got to be not including the effect of inflation. That means the real cost of debt is still pretty close to zero. Pardon me. Sorry about that. So the real cost of debt is about zero right now. So even though it's a dramatic escalation, it's dramatic from almost as actually a negative position just a matter of a week ago. Right.
And a yield that is still actually well below what you'd pay for bonds in the United States, of course.
I think we should running about 2.8%. Yeah, that's right. Yeah, so it hasn't hit anything like crisis. Crisis has risen by this much. Yeah, from what level? I actually had an interesting conversation with a mathematician yesterday in Goldman Sachs who said he was being hauled over the coals for getting disastrously bad returns. And he then, first of all, he told his boss how to expand the columns on the spreadsheet to see what the hash sign stood for. And then it turned out that his target was actually negative and he was getting a positive return. So this is a bit similar on that front.
So, it's all of that points to the question, is it a storm in a teacup then? Is it just sort of like, the yields were very low. They've reached sort of the proportions where they're getting a bit closer to where they are in other parts of the world. And, they go back, they have another election. The election is, sort of like a hung government. And they, as I say, muddle through somehow without necessarily pulling out of the euro and causing the catastrophe that would follow on from that.
Potentially. I mean, I think the interesting thing is that, and Yanis Varoufakis made a similar point to me in his blog a couple of days ago. This is massively overplaying the hand by the president of Italy, because first of all, yes, on Monday we were saying that. I've seen some conspiracy theories saying maybe and I'm not against the fact people try conspiracies, whether they work or not, it's not a story. But maybe the reason that Five Star and the League put forward Savona, as the candidate for finance minister was to provoke this outcome.
Yeah.
Well, the trouble with that is that, yes, okay, that might be argued, but they didn't require Mattarella, who's the president. I'm going to keep on checking my names here.
Yeah, you're right on that.
To a point. What's his name? The Mr. Scissors.
Is it Sanos or
Cottarelli?
Oh, Cottarelli.
So now there's no way that Five Star could have compelled Mattarella to have the idea of offering the prime ministership to Cottarelli, who was notorious for cutting back spending. Back in 2000 and I think it's 12-13, literally in the name of Mr. Scissors. He's not the only other economist in Italy.
Yeah.
So even if Five Star was setting it up, what Mattarella has done is the extreme idea of saying, yes, we know you all voted to end austerity and to loosen the shackles of the euro, so I'm appointing somebody who wants to impose austerity and maintain the euro.
Yeah, well, that's almost as he's working on their side. I mean, if you're looking at conspiracy theories, because it's like saying, well, let's give you the worst possible antidote to what you've asked for, and we'll give you a chance to vote on it in less than 2 months, so you can see what it's like in the meantime. Hence, we are seeing the League and Five Star in the polls. They are increasing their lead. They've got over between them now well over 60% and rising. So they're going to be in a position where they clearly form a majority coalition government, and they will up the ante, presumably. They'll say, well, we were trying to moderate things last time, but now we're going to up the ante, and we're going to say, yeah, damn it, we want to be out the euro.
Yeah, and I think this is quite a danger because, I mean, particularly since Cottarelli initially believed he could actually be a caretaker Prime Minister and put forward a budget which is based on his ideas, which are entirely about the need to cut government spending, and get it passed by a parliament where there was already a majority of Five Star and the League against him. Now he's actually realised there's so little prospect of him actually being accepted by Parliament. He'll be voted down straight away. I think but the most latest news is that he decided not even to nominate or go ahead, or to just be a caretaker and call instant elections, which will be in July. And as you say, with July, we're only talking barely less than 2 months. I can see the European authorities and the sort of centre opponents in Italy going all out to try to throw as much mud as they can at Five Star and the League. And there's plenty of mud that can stick in terms of the League's racist policies about migration and so on. But none of that is likely to turn the electorate in that length of time. So what is going to come back, the League and the Five Star, if they stay together in the next 6 weeks, and again, I can see the centre powers trying to undermine their coalition, they come to power, they'll have a massive majority, probably one of the highest in the history of Italy, I imagine. And they will then they're able to impeach the president if he hasn't already been impeached. So that he'll go. Cottarelli won't be there anymore. They'll have to appoint, I mentioned that, I'm not sure, but I presume the Parliament originally elects a new president. They'll elect somebody who's compatible with them. It's a huge miscalculation by the pro-Euro forces.
But if they get what they want, if they try and pull out of the euro, I mean, then nobody is going to want to buy their bonds. Well, because there'll be bonds in euros, and they're going to say, well, that's going to be worthless when you're not using that currency anymore. And obviously the ECB is not going to be supporting them because they're saying, well, you're leaving anyway, and in any case, you're not adhering to our rules. So isn't there a danger that the country is going to become bankrupt in this process?
That's a possibility, but I think more likely what they have said. I mean, what you have with their nominee, again, Savona, the nominee for the finance minister, is that he's always been critical of the euro, and as I said, he's got support in terms of economic theory from Wynne Godley at one extreme to Milton Friedman at the other. Both of them said the euro should never be formed. So he's simply saying something which is sensible, but it goes against the political consensus of the powers that be in Europe. But what he's put forward, I'm not sure if it's his actual proposal or it's come from somebody else, but the idea of what they call mini bots, and bots are ordinary treasury bonds, which are that's how they translate BOT. Ordinary means ordinary treasury bonds, which are short-term public securities that are currently issued by the Italian government. He's going to issue what he called mini bots, worth between €1 and €500 to people who are owed a tax return. When they get that mini bot, it is not legal tender. It is not something you have to accept. If somebody offers you that for a cappuccino, you can say, no, I want euro. But it will be used, you can buy train tickets because the train system, of course, in Italy is government-owned. There are government-owned petrol stations. You can pay taxes with it. You can pay local
So it's like
rates,
a government
et
IOU to be used on government services, in effect.
And the last person to do this on any particular scale was that well-known radical revolutionary Arnie Schwarzenegger.
Right.
Because when Arnie was Republican, governor of California during the crisis, because California is effectively it's a state of America, it can't issue its own money, it did run out of its own state tax revenues, and he started paying his workers, state workers, in a certificate, which is like an IOU will pay you later type thing, as a tax. Within this can be used to pay your Californian taxes, and that worked okay for a while. So what Savona is proposing is the same sort of thing, and fundamentally what this means is you have a second, actually a third source of creating something you can use for transactions, which is roughly speaking money. Because at the moment there's only three ways you can create money. One is by in terms of Italy's own realm, by the government spending more than it gets back in taxes, but the euro cuts that particular option out, so that's gone. You can borrow money from the banks, and that's what they did when the euro first came in. There was a massive increase in private debt that began literally as soon as the euro came into existence, because without government money creation, just for the nature of needing money, expanding money supply to support expanding transactions, Italian companies and Italian households began to borrow from banks in ways they hadn't been doing for the previous 30 years. So that increases money, but equally it increases your debt as well. It's not like government money where you get paid government money, you don't have a liability to pay it back. When you get money from a bank, you have got a liability to pay it back. That doesn't particularly work. So Italy's been strangled for money by the euro for the last 2 decades. And what's the mini BOT would gives another form of a way of making transactions, which is not based on debt. So if you get a mini bot, that increases your equity. You don't lose. When you get money from a bank, your assets go up with the bank account, but your liabilities go up with the debt you owe the bank. It's a zero net game for you. But if you're owed taxes by if you paid more tax and pays your own system than you actually owe, then what they'll do, rather than giving you a euro to pay back your back, they'll give you mini bots, so the state can do it more easily, and then those mini bots can be used for a whole range of transactions. Effectively, it's creating an efficient means for transactions. Now, of course, it won't necessarily sell at the same rate. It'll be issued on a one-for-one basis when they do issue them, but it will enable Italians to spend. And this is the real problem with the euro, is it stopped them spending. And as a result, the economy has barely grown in terms of usual growth rates of capitalist economies for 20 years. It's 9% bigger than it was in 1999, whereas England, it's hardly an exemplar of a vibrant economy, of course. England's grown 44%. So it's been the strangulation. The mini-bots could stop it without them having to leave the euro. So I think what they'll first do is go for the mini-bot route. They will not say we're abolishing the euro.
Right. And you could extend that presumably as well, couldn't you? I mean, not just if you've overpaid your taxes and you're getting a tax rebate. If you're a government worker, presumably you could get paid in this form as well, couldn't you?
That's also possible, yeah. So I think they'll go that route first of all, and in effect they'll leave it with the ECB to retaliate rather than shutting down the ECB directly. And then, I mean, this is again, Yanis Varoufakis had a similar idea, which he could have made the decision to pull this weapon. It's either I had one of my Patreon colleagues pointed out that I may have got my facts wrong in my review on Amazon, which I published just recently about Yanis's book. My recollection was, and I wrote that review just after I read the book, that Yanis is going to default on IMF bonds, and that would trigger a cascade which would undermine the whole ECB program. My correspondent on Patreon said maybe I got that wrong, and it was ECB bonds were going to default on. Whichever way it was, there was the threat to default on the bonds and then trigger the European Central Bank to block the use of euro deposits, at which point they would issue a similar authority to the mini-bots to allow Greeks to transact with each other. Now, I think, in other words, what's going to happen with the Italian, and they're going to be the election, they're going to win. There's no, I cannot see any way other than 5-star in the league being victorious in July and a huge majority being able to come in and say, right, we're doing all these things. The retaliation of the ECB with them say, right, we're shutting down your access to the lending authorities, we're shutting down the Italian banks, if it was using euros, then the mini-bot would become effectively the only form of money in Italy, and that may well force
that then becomes a transitional step to a lira, doesn't it?
Yeah, I think so.
So, yeah. I mean, if the idea of these mini bots before this election, I mean, the ECB is not going to. Presumably, can this legally form a currency? I wouldn't have thought so under the. Well, no, the difference is this is where if you look at any bill, most people say this is legal tender for all debts in X territory. The bots are middle. It's not legal tender. If you are selling something, you're selling
you want to be selling a cappuccino and your price is €3, and I give you €3, you say, I'm not going to give you the cappuccino. I'd say, look, I'm going to call a cop here and, show him that I'm paying you €3. You've got to give me the cappuccino. If you offer 3 mini bots, they can say, I'm not going to pay it to you. Call the cop can say his decision. It's an optional extra. But the idea is once you have a form of payment which is accepted across a wide range of areas, then people might accept it as a discount. So you might tend to face value 3.5 mini bots to get a €3 cappuccino. That might happen. So it's not legal tender, and therefore it doesn't breach the monopoly that the euro has on being legal tender within the eurozone.
We've been through all of this before, of course, with Greece. I mean, Italy, of course, is a far larger economy than Greece, so it's a far bigger deal. But Greece sort of rolled over and said to the ECB, "Yeah, look, we'll do what you ask of us. We'll go through this whole process of austerity." A long drawn out affair that's still going on. What's to say Italy isn't just going to somehow, for some reason, follow that same approach? Because it comes down to people. I can't recommend strongly enough people to read Yanis Varoufakis' Adults in the Room. It's an incredible expose, beautifully written as well, of the whole process, including the breakdown of Syriza. And as part of that, he really fundamentally says that Alexis Tsipras began to suffer from Stockholm syndrome. The whole idea that you start to believe your imprisoners and torturers are the good people and you're the bad person. He just basically rolled over and wouldn't do anything without getting Merkel's okay, without realizing at the same time Merkel was crushing him. And then finally imposes austerity stuff, which of course when he campaigned, he was exactly the opposite way. That's why Yanis resigned from the party when all that happened. So that's Tsipras. Now I must say that I had a few left-wing Greek correspondents who wrote to me when the whole Syriza thing was rolling, saying, "Look, don't trust Tsipras. He's a PR junkie. He's a narcissist. He won't live up to what he's saying. It'll all come and end in tears." Now those correspondents turned out being right, and it was Tsipras's decisions. And of course, the classic point with Tsipras was after being given yet another ultimatum, he went back and ran a referendum about whether he should or should not succumb to the terms of the European, the Troika's demands. And the answer every week was a very strong no. 60% said no, don't do it. Now, Yanis explains in that book, this is something I've heard externally, but I wanted to see it verified by him. He was absolutely delighted. He was proud of the Greek people having the guts they had to do that. He rushed into Tsipras's room and found the depressed man and depressed staff. They wanted to lose that referendum. They wanted the Greek people to tell them, yes, succumb. Now, even though they said don't, they did succumb. So it comes down to the spine of the people involved. And here, I don't know the leader of not much about the leaders of the Five Star. I do know Beppe Grillo, and Beppe Grillo has got spine. He's the person who founded Five Star. And on the other side, you've got a right-wing, separatist movement, as the League was. They're likely to stick to their guns as well. Yeah. So I can't see them rolling over the way that Tsipras did. So how would, given that there's a timetable mapped out now and it's all very quick, how do you think the EU and the ECB are going to react to this? I mean, Angela Merkel's not going to take this lying down, is she?
No, and she's got enough problems back domestically anyway with the increasing votes for the right back in Germany. So this is the classic things fall apart syndrome. Something which should never have been created is going through the process of breakdown. They may well decide to loosen the constraints. They could decide, okay, let's just let's buy all the Italian bonds. Let's promise behind closed doors, don't tell anybody. That we're going to back your government bonds no matter what. The Draghi, whatever it takes, plea part 2. Yeah, they may do that, or they might decide we're going to bring you to your heels. We're going to shut your banks down now. Yeah. Now,
they're unlikely to do that, though, are they? I mean, that first
God
approach.
God knows.
So they were talking about ending their QE program, the ECB, in September or sometime this year. Anyway, that seems to have gone by the wayside. They were buying a lot of Italian debt as it stands. I guess, I mean, the one thing they'll do is they'll say, I mean, because the worst thing in the world would be to say, hey, guess on top of all of this, we're just not going to be buying Italian debt anymore because we're just not buying any government bonds. So I guess they could ramp up that program or extend it. I mean, that might help.
Yeah, I think that's probably what that sounds feasible. But it's much more lively politics than with Greece, because if you lose an economy which is something in the order of 10 to 15% of the entire European Union, game over for the euro.
Which would be, I mean, everyone, I don't think too many people would be very upset about that, would they? I mean, if we then said we don't have the euro and we just had a common market, then maybe Britain would feel happy about being part of it as well. We never were part of the euro, but as we've said before, we have suffered the repercussions of it in this country. It was the one step too far in the European experiment, wasn't it? A common market's fine. It's still sort of like it's a trading bloc, and there's nothing wrong with that.
No, the trading bloc was fine, and even using the ECU, the European currency unit,
for
as a
businesses
way of handling it.
Yeah, exactly, for businesses
that was
to
fine.
deal with.
It was going to a single currency with no no matching treasury, and with ridiculous limits on government spending. Because, as I said, like putting a 3% ceiling, the average for the American economy, excluding the First and Second World War, for the last 120 years, has been a deficit in excess of government spending over taxation receipts of about 2.3%. So to set a ceiling which is 25% above, pardon me, the historical average of the world's biggest economy is nonsense. The tolerance band should have been 10%, if anything. Now, the only way to get out of it is to change those rules and allow, say, a government at level of 150% and to allow a deficit of 15%. And then the rules don't even matter, and you might be able to get somewhere. Yeah. But they can't hang on to the Maastricht Treaty rules anymore.
Right. Yeah, that's a big ask, though, isn't it, to see all that change happening in the space of 6 or 7 weeks. I guess the downside out of all of this as well, apart from the fact that a lot of people have obviously lost a lot of money in all of this, but perhaps we shouldn't feel too sorry for investors. But the bad news out of all of this is the fact that Donald, the euro is going to look pretty sick. The European economy is not going to look too good, and conversely, that's going to help boost the US dollar and strengthen the US economy, and it's going to make Donald Trump look good. And aren't we going to hear about that over the next 6 weeks?
He'll be taking the credit for the rising US dollar, I'm sure.
Yeah. All right. Talk again soon, Steve. Thanks for that.
Okay.
Next time we ask, growth. Are we kidding ourselves? I mean, there's this concern now that maybe growth, even before the whole thing in Italy didn't happen, that growth in Europe wasn't seeing the sort of growth that we expected, and the US also seems to be slowing down a bit now. So are we kidding ourselves when we expect that at some point we might actually get up to 3 or 4% growth in a year? And what does it matter if we've got such slow growth? I mean, Japan has been trundling along at or below zero for many years now. Are we a little bit preoccupied with growth? We'll look at all of that next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Thanks for listening.